Welcome, everyone, to another episode of the Reinsurance podcast. I am your co-host, Jerad Lee.
And I'm Ben Rose, joining virtually this time to say happy Thanksgiving to you all.
Happy Thanksgiving. It's the end of the year, and it's a busy time for everyone, but the reinsurance news does not stop. So we are doing a virtual recording today just to get everyone updated on the most recent action in the market. So we will do this one virtually, but good to see you, sir, even if virtually.
Indeed, thank you for the delightful Thanksgiving party. I shouldn't tell too many people about that because then they'll get excited.
A multi-day food coma for all those listening, and to our American listeners, I hope you two had a very good and enjoyable Thanksgiving with your families. But without further ado, into the news. This is a super interesting time right now. This, as we talk to our sort of friends and colleagues around the market, this 1/1 is proving to be super challenging. And we've been talking about those conditions for the last couple months, sort of seeing this on the horizon. But you're really seeing it now, where there was a piece that came out with Andy Marcel from Aon the other day, talking about how there's this real sort of stalemate in the market with, deals not getting firm order terms and quotes being really slow to come in. And there's a lot of news articles we want to sort of run through today, just kind of highlighting all the macro factors that are kind of driving some of this stuff. So one of the first ones I wanted to jump into here was Swiss Re came out with this updated report talking about how there seems to be this persistent U.S. inflation and this real concern that that's going to drive a worsening recession into 2023. As we look at the market as a whole, these sort of seeing these things on the horizon, I think, is making everyone kind of take pause and try to brace themselves, not just for this renewal, but what the next year or so looks like.
Yeah, I'd absolutely agree. The dynamics generally on a forward-looking view are feeling more uncertain than they have in quite a long time, because you have acknowledgement of what we thought was an old normal, where you still had people putting off the fears about climate change, a incredibly flat and unmoving interest rate environment and an inflationary environment, and a relatively strong boom post-pandemic, or what seemed like was going to happen. And obviously the war in Ukraine, the energy crisis, etc., have all come in very, very rapidly and seem difficult to shift at the moment. So on a macroeconomic level, looking forwards, lots to be concerned about, but equally lots of people who want payback for a difficult catastrophe year, which again has become the new normal, it seems, to have a large event year every year.
Yeah, well, and for the last number of years, everything seemed to be, even though we were having increasing catastrophes, and we've talked about that, it was all sort of modeled. Everyone was sort of managing it, and there's a little bit of a push for hardening prices and those things off the back of that. But you're absolutely right. There's so many more things that seem to be happening right now that, you add the interest rate environment shift and the fact that it was this sort of decades long soft market that I think we're still trying to wrestle with. What does a hard market look like? We're not really used to one as a market anymore. So I think you're seeing a lot of response to that.
I don't know what figures you've seen, Jerad, but I've seen a few numbers come out that are saying sort of 20 to 30% above inflation for property cat. And is that enough is the question. I think that might be a starting point, but I think that's why people are holding back so long. It was the same at Baden-Baden. It was very clear who was buying the drinks on the broking side, and the underwriters very much holding their cards as close to the chest as they can, because that soft market, as you said, has persisted for so long. They don't want a false start, a temporary rate increase that then resumes its downward trajectory. So looking at things like the amount of industry capital now, we've seen a few charts come out in the Insider recently showing that decreasing amount of capital dedicated to reinsurance. That constraint on capacity is surely going to have an impact, especially as ILS funds deal with the fact that their usual backers have now got some very attractive alternatives as well.
Yeah. Well, and that kind of brings me right into the next article I wanted to talk about here is coming out from Hannover, just this belief that the reinsurance pricing dynamics are going to materially change next year, right? So again, it's all of these things that as the reinsurers for the first time have, the power in their hands, it is this lens as to what the next year looks like. I think you're spot on with not wanting to false start where, they see almost potentially a moment in time to reset the expectations in the market, and they don't want to go out and just cover inflation then only to get burnt if the market evolves again next year. So they're trying to manage that piece of the conversation. But all the big reinsurers are doing these studies and looking at the change that's expected next year, and that's certainly one.
Yeah, and I think one of the areas that's been quite interesting to watch has been the announcements coming out from various lighter vehicles for distribution, I guess. So MGA is a big topic at the moment. We saw a Lemonade coming out to give comment during this month to talk about how they were going to assure themselves of continued capacity. But I think that's a theme in general, right? Those with their own capacity are in a pretty stable position, I would say, and are looking forward to getting what they can get. However, those that heavily depend on third parties to provide them their capital, it's very difficult for them to paint the picture that they're going to be able to deliver a comparable return on that capital for those entities, given the environment we're in with inflation, with interest rates offering attractive, safer, maybe less correlated or more correlated alternatives, but even so very safe but high return assets that will sort of have a guarantee on them to outperform our historical performance for the last 5 years as an industry. So worth tuning into our episode with Jacob recently on the economics of reinsurance. So
yeah. Well, and it really is highlighting the sort of interconnectivity of the different steps in this value chain, right? With if the end capital is sort of drying up or going elsewhere, the impact that you're seeing on first the retro market, and then if retro capacity pinches, the impact that it has on the reinsurers, and then the knock-on effect that has through to the insurers. Like it's all very, very connected and reliant on the other component parts still working, and you're seeing that contraction feel it's being felt right the way through the chain. Going to your comment on the losses, you're seeing Lloyd's come out recently with a number of about 3 billion in Ian claims after their reinsurance. So their net position still being about a $3 billion loss. It's an interesting one because you're looking at the industry estimates being between 60 billion and 75 billion for Ian. So Lloyd's sort of net position there being 3 to 5% is kind of what they're looking at. It's kind of highlighting one, the quality of the reinsurance that they've been purchasing and the protection that they've received from that. But even with their reinsurance in place, you're seeing a lot of it hitting balance sheets. And again, this is sort of having a knock-on impact as they go into renewal season.
Yeah, and what the interesting thing that it pointed out to me, perhaps I'm guessing too much here, but is actually that number is very small, and perhaps that's a signal of Lloyd's current relevance or lessening relevance to the reinsurance world in general. To be only ultimately taking 3 to 5% of the largest hurricane event in recent memory suggests that Lloyd's relevance as a reinsurer of scale of the typical hurricane bread and butter risks has decreased a lot, and I'm sure that will make a lot of their capital providers very happy, but it certainly means quite a big identity shift for a market that traditionally was seen as a stalwart provider of reinsurance for traditional markets. Yeah.
Well, and there was another article that had come out with the Lloyd's exec essentially looking at this hardening market as a real opportunity for them to grow and reestablish themselves in the reinsurance space as a capital provider. We'll see how that pans out. Historically, you've seen the big reinsurance deals shifting to slightly more efficient areas like Bermuda, and the sort of company markets across Europe. But if the market begins to really harden, Lloyd's begins to be another opportunity to sort of find capacity where it's needed. So we'll see how Lloyd's can position themselves, and if they have a chance to really make an impact at 1/1 with increasing reinsurance inwards deals.
Yeah, I think we saw some fighting talk coming out from John Neal, saying I think he was envious of the underwriters, or wished he could be an underwriter right now, which was a good comment. But they have put their money where their mouth is in a few places amongst the syndicates. I'm sure that there's a lot of pushback conversations happening elsewhere, depending on rate adequacy in different lines. But as far as a couple of examples go, we saw Beazley successfully pull off a sizable capital raise to really go after the market. We also saw key Brits automated follow syndicate, basically picking up a massive chunk of new capacity to really go after the market. But that was a controversial topic in itself, I think, because we saw quite a few debates happening around the market as to whether Lloyd should be quite so supportive of a relatively new and without little proof, to his name, a vehicle that's relying on algorithmic underwriting, whilst at the same time being very prudent, shall we say, and careful about how much it allocated towards its more human underwriters.
Yeah, well, that was one. That investment was a really, really contentious one in the market, as you say. But there's not enough evidence for how well it's working, and we've seen this when you talk about the human underwriters. The market would react very negatively to this idea that Ben had a stamp, and in year one there was no claims on Ben's stamp, so let's triple or quadruple or 10x his capacity for next year because look how good he is. Like, when we talk about it from a human lens, we recognize that there's some element of luck, whether the wind blew or the rain fell kind of luck in reinsurance, especially in the catastrophe space. So for Key to have a couple years that were okay and just get so much more capacity right out of the gates, I think it did raise some alarm bells, and it is unproven until we have 4, 5, 6, 10 years of returns and results that will let us see is this model sufficiently better or not. But yeah, it's a really interesting one to watch.
I think it speaks, though, partly to Lloyd's passion at the moment for innovation, which is really good to see. They want to find out what this future business model is, but equally, and the reason it's raising eyebrows so much, the quite limited avenues that they've been able to find ways to do that. So the fact that there is only Key, that's been set up as a reputable kind of algorithmic underwriter within all the syndicates at Lloyd's, I think is the reason why they're having to go so big on that one in order to really test out the opportunity to explore algorithmic underwriting. We would be in a very different position and looking at this very differently if Lloyd's decided they wanted to allocate a lot more, or to approve a lot more capacity being allocated towards algorithmic underwriting if it was spread amongst 10 of the leading syndicates.
Yeah.
But by circumstance almost, because Brit are the ones leading the way here, they're the only ones who are getting this giant chunk, and it seems a little bit unbalanced. So hopefully others will take encouragement from Lloyd's attitude towards Key and start to establish and explore similar types of vehicles, and we'll learn in a few years' time whether they were a good idea or not, I'm sure.
Yeah, exactly. Well, and I think it potentially works nicely in sort of the large commercial single risk space where those deals get priced sort of individually and independently. When you look at this sort of strain that the renewal season is having right now for reinsurance buyers, one of the things that the market's very aware of and comfortable with is this idea that you're pricing clients on a portfolio basis to some degree, right? Even if you're only writing a couple of those deals, you're looking at it from the lens of, well, what is their casualty program going to do? Should we grow our position there? Is that a better book? Should we write a larger line there to help us offset and give them support on other lines that might lose a bit of money? The market looks at big clients, especially, in kind of a bit of a holistic lens. And when you think about the idea of moving more towards algorithmic and things, it removes that component, which I think the industry is kind of cautious around. Is, yes, the casualty deal is priced super well, but if we're not able to balance those parts of the programs out, do other parts of their reinsurance purchasing needs become inaccessible or too expensive to purchase? And I think those concerns are sort of in the backs of people's minds as they begin to look at what the future might look like here. So yeah, it's a fascinating one to watch.
Yeah, we await the algorithmic underwriting vehicle that can successfully do horse trading of
Yeah, exactly.
a bit of that in exchange for a bit of something else, and so.
Yeah. Any other stories that you wanted to touch on as we sort of wrap up the buzz of this 1-1?
I think probably just the general theme, and I think we haven't seen the end of it, is watching various reinsurers announce pullbacks from certain areas of business, but also at the same time seeing others pop up and appear. We've seen a mix so far. I know there was one example where the new venture was actually pulled because they realized the conditions just weren't right right now. But I think there are the brave few within both broking and reinsurance, it looks like, who are seeing this as a real opportunity to do something a bit different. So that would be my watch this space for the next month, as we see, whether these reinsurers come through, whether they decide to walk away, and whether we get any new ventures popping up as a result of it.
Yeah, and again, I think this is what's making this sort of hard market more interesting than others, where historically you've always seen like the class of X out of Bermuda get set up to sort of respond to this pinch, but because of the interest rate conditions and everything else being so different right now, there's not been this real commitment to seeing, oh, we're going to see a dozen new reinsurers pop up in Bermuda to respond to this. So it looks a bit different, but you're right, there's always going to be opportunities. And this market will always find ways to get deals done. So people who have set up business models and gone out to raise money for a new venture, 18 months ago, when they would have began that journey of getting all that stuff in line, are now out going, we're going to pull this venture. What it looked like 18 months ago when we began the sort of business structuring of what we wanted to do is no longer the landscape we find ourselves in. But you're seeing loads on both the broking side and the capital side going, but they can spin up something new now in response to the climate they find themselves in at present. So that will be a watch this space for sure. What will the class of 2022, 2023 look like? And where do they set up and how does that begin to look? It'll be a fun one for us to watch for sure.
Yeah, indeed. Bring on December. It probably won't be done by the end of December, so bring on January.
We're gonna have the 1-1 summary in the end of March at this point. But no, it'll be a fun one to watch. We'll do another update in December with kind of where we're at then, and we'll see if there's more movement on quotes and pricing and all this. But as we go into December now, wrapping up November, a super interesting market to watch. And for those who are in the weeds every day, let us know what you're seeing as well, because we happily pass along that information, those updates to its listeners.
Thanks, everyone. See you soon.
Perfect. Thank you, everyone.